I am going to speak to you today about a subject that usually empties the room at high society dinner parties. If I were running for office, this is the speech that would lose me every single vote from the donor class. But I am not running for office, and I have enough money to buy my own dinner, so I am going to tell you the truth. The truth is about the peculiar. You sit there staring at your glowing screens, intoxicated by the green numbers and the dopamine hits of a bull market that has gone on so long you have forgotten that gravity is not merely a suggestion but a law of physics. You believe that because you are 35 or 40 years old and have stumbled into a bit of equity in a tech company or bought a rental property when interest rates were functionally zero. You are a financial genius. Let me disabuse you of this notion immediately because it is the kind of asinine folly that precedes a total wipeout. You are not a genius. You are a beneficiary of a Lollapalooza effect of cheap money and mass delusion. And when the tide goes out in 2026, or perhaps sooner, we are going to find out that most of you are swimming naked. The world is full of foolish gamblers who think they are investors, acting like a man who buys a lottery ticket and, upon winning $10, believes he has cracked the mathematical code of probability. It is pathetic. The market does not care about your retirement plans, your ego, or your desire for a comfortable mid-life existence. It is a mechanism designed to transfer wealth from the impatient to the patient, and right now you are vibrating with an impatience that smells like ozone before a lightning strike. You look at 2026 and see a continuation of the trend. I look at 2026 and see a graveyard for the mediocre. You are ignoring the iron rule of the universe, which I have preached since the days when $1 million was actually a lot of money. It is not brilliance that makes you rich. It is the avoidance of stupidity. I have spent 99 years watching people ruin themselves, and the pattern is always the same distinct mixture of arrogance and ignorance. You want to know how to make money in 2026. You are asking the wrong question. That is the question a fool asks. The wise man, the man who keeps his fortune while others are jumping out of windows, asks the inverted question, what will kill me in 2026? And then he assiduously avoids doing that thing. This is the mental model of inversion inspired by the great German mathematician Carl Jacobi, who said, invert, always invert. If you want to help India, do not ask, how can I help India? Instead, ask what is doing the worst damage to India and stop doing that. If you want to be wealthy in 2026, do not ask what stock will double. Ask what action will ensure I lose everything. And then here is the difficult part for you. Modern addicts do not do it. It sounds simple, but as I said at the 1998 Wesco annual meeting, it is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. You are all trying to be very intelligent, chasing complex derivatives in crypto, tokens that are nothing more than rat poison squared, while ignoring the cliff edge you are dancing upon. Let us look at the titans of the past, the men who built the world you take for granted, like John D. Rockefeller or Andrew Carnegie. Do you think Rockefeller sat in a room twitching over the daily fluctuations of oil prices, wondering if he should leverage his position 10-1 to squeeze out an extra percentage point of return by Friday? No, that is the behavior of a degenerate at a racetrack, not a capitalist. Rockefeller and the early builders of Berkshire Hathaway operated with a fanatic discipline that would make a modern hedge fund manager vomit. They understood that the first rule of compounding is to never interrupt it unnecessarily. They built fortresses. They focused on ownership of cash-flowing assets, widening the moat, and keeping costs so low that they could survive any panic the market threw at them. Contrast that with the modern investor, who is leveraged to the hilt on a mortgage he cannot afford, leasing a car he does not own and buying stocks on margin because he saw a video on the internet. This is not investing. This is financial suicide on an installment plan. At the 2003 Berkshire AGM, I warned you that there is no way you can live an adequate life without many mistakes. But there are mistakes. And then there is the systemic folly of the current generation. You are playing Russian roulette and bragging that you haven't blown your head off yet. The single greatest threat to your wealth in 2026 is not inflation. It is not the government. And it is not the collapse of the dollar. It is your own temperament. It is your inability to sit still. Pascal said, all of humanity's problems stem from man's inability to sit quietly in a room alone and looking at your portfolios. He was right. You feel the itch to do something, to act, to trade. That itch is the devil. In my own life, I have made plenty of mistakes, but the ones that haunt me are not the stocks I bought that went down. Those are tuition fees. The real disasters were the errors of omission and the errors of ego. I will tell you of a specific mistake I made, one that makes me sick to remember even now. In the 1970s, I had the opportunity to buy a significant stake in a high-quality business that was trading at a discount. I knew the business was good. I knew the management was decent. But I was trying to be too cute. I wanted to buy it at a specific price, a bargain basement price, because I was worshiping at the altar of Ben Graham's cigar, but investing rather than evolving. I haggled over pennies. I let the deal slide because I wanted to feel like I had won the negotiation. That decision, that refusal to pay up for quality cost me, and by extension, my partners, hundreds of millions of dollars in future compounded wealth. I was being smart about the price, but stupid about the value. I ignored the reality that a great business at a fair price is superior to a fair business at a great price. I let my ego dictate the terms, and the market punish me with the silence of missed opportunity. Now apply inversion to your current situation as we approach 2026. What guarantees you will lose money? 3 things: liquor, ladies, and leverage. I cannot help you with the first 2. That is a matter of your own moral fiber. But I can speak to the third. Leverage is the only way a smart guy can go broke. If you are over 35, you likely have obligations, a family, a mortgage, a reputation. If you take on debt to chase returns because you are envious of your neighbor who got rich on some speculative bonanza, you are inviting ruin. Envy is a really stupid sin because it's the only one you could never possibly have any fun at. There's a lot of pain and no fun. Why would you want to get on that trolley? If you have leverage in a downturn, you do not get to wait for the recovery. You get wiped out. The bank does not care about your long-term thesis. They want their money. Inverting the problem means you must purge your life of fragile debt. If you are heading into a storm, you do not hoist more sails, you batten down the hatches. I am not your advisor. But if I were, I would tell you to consider paying off every cent of high-interest debt you have immediately, even if it means selling your beloved winners, because when the liquidity dries up, cash is not trash. Cash is oxygen. The modern fool looks at the stock market and sees a casino where he is due a payout. He buys things he does not understand, sold to him by people who do not care about him, using money he cannot afford to lose. This is the antithesis of the Berkshire system. We buy things we understand. We buy them to hold them forever. We do not care if the stock market closes for 5 years. Can you say the same? If the market closed tomorrow and did not reopen until 2030, would you be panic-stricken or would you be content? If the answer is panic, you are already dead. You just haven't stopped moving yet. You must invert your behavior. Instead of seeking the highest return, seek the lowest risk of permanent loss. Instead of trying to be the smartest person in the room, try to be the most disciplined. The world is full of brilliant people who are disasters financially because they lack the temperament to be rational. They get swept up in the crowd. As I said at the Daily Journal meeting in 2019, if you're not a little confused by what's going on, you don't understand it. But there is a difference between confusion and participation in madness. You can observe the madness without buying a ticket to the asylum. You must understand that the economy is an ecosystem, not a machine. It adapts. And right now, the ecosystem is adapting to punish the excesses of the last decade. The easy money era has rotted the brains of a generation. You believe that stocks only go up. You believe that the Federal Reserve will always save you. This is a delusion. We are returning to a world where capital has a cost. And when capital has a cost, the businesses that require constant infusions of cash to survive, the very businesses many of you are obsessed with, will wither and die. This is the great winnowing. To survive it, you must adopt the mentality of the survivor. You must be ruthless with your own portfolio. Look at every asset you own and ask, if interest rates stay at 5% or go to 8% for the next decade, does this thing survive? If the answer is no, get rid of it. Do not hope. Hope is not a strategy. Hope is for people who do not do the math. You must be willing to destroy your own best loved ideas if the facts change. Darwin didn't say the strongest survive. He said the most adaptable survive. In finance, adaptability means recognizing when the game has changed and refusing to play by the old rules that no longer work. There is a terrible asymmetry in financial life that you must respect. You can spend 20 years building a reputation and a fortune, and you can lose it in 5 minutes if you are caught on the wrong side of a leveraged trade during a panic. That is why we emphasize safety first. It is not because we are cowards. It is because we understand the mathematics of zero. Any number multiplied by 0 is 0. It does not matter how big the number was before the multiplication. If you allow a 0 event into your life, a margin call you cannot meet, a lawsuit you cannot survive, a bet that goes to 0, you are finished. The greats like Carnegie understood this. They took risks, yes, but they were calculated risks where the downside was survivable. They never bet the farm. You on the other hand, are betting the farm, the tractor, and the livestock on the idea that a line on a chart will keep going up at a 45-degree angle. It is madness, it is asinine, and it will end in tears. You must develop the capacity to suffer. That is a strange thing to say in a manifesto about money, but it is true. In investing, you get paid for waiting. You get paid for enduring volatility without panicking. If you cannot watch your net worth drop by 50% without becoming unglued, you have no business being in the stock market. You should be in treasury bills. Standard doctrine at Berkshire is that we are willing to look foolish in the short term to be right in the long term. We sat on billions of dollars of cash for years while the pundits called us out of touch, senile, and past our prime. We let them talk. We sat on our hands. And when the opportunities came, we had the ammunition to fire the elephant gun while everyone else was looking for a band-aid. That is the power of patience combined with cash. But you are fully invested. You have no dry powder. You are running a marathon at a sprint pace, and you are about to hit the wall. You must invert your desire for action. Embrace the boredom. If you are finding investing exciting, you are doing it wrong. It should be dull. It should be like watching paint dry or grass grow. If you want excitement, take $800 and go to Las Vegas. It is cheaper than day trading, and you get free drinks. The path to surviving 2026 is not paved with brilliant insights or secret information. It is paved with the refusal to be swept away by the current of popular opinion. It requires you to be a contrarian, but not just for the sake of it. You must be a contrarian when the facts support you. Right now, the facts suggest that valuations are stretched, debt is high, and the crowd is complacent. This is the perfect setup for a disaster. By inverting the problem, by focusing on what you must avoid, debt speculation following the herd, and ego-driven decision-making, you build a firewall around your wealth. You may not get rich quick, but you will not get poor quick either. And in a world where everyone is trying to get rich quick, the man who slowly avoids poverty eventually ends up owning everything. Stop trying to be a genius. Stop trying to impress your friends at the cocktail party with your hot stock picks. Start acting like a grown-up who understands that money is a tool for independence, not a toy for entertainment. If you can do that, you might just survive what is coming. If not, well, I will not say I told you so, but the numbers will speak for themselves. You sit there with the arrogance of youth, even if the gray hairs are starting to show at your temples, believing that time is an infinite resource, a river that will flow forever in your favor. It is not. Time is a decaying asset, and for those of you over 35, the decay rate is accelerating. When you are 20, you can be an idiot. You can blow up your account, go bankrupt, and still have 40 years to let the magic of compounding salvage your wreck of a life. But once you cross the threshold of 35, the mathematics of recovery turn against you with a vengeance. If you lose 50% of your capital in the coming storm of 2026, you require a 100% return just to get back to where you started. Do you know how hard it is to get a 100% return without taking on risks that are likely to kill you again? It is nearly impossible for the average mind. You are playing a game where the innings are running out, yet you swing at the ball as if you are in batting practice. You treat your capital as if it is easily replaceable. It is not. Capital is crystallized time. When you lose money on a foolish speculation because you were too lazy to read the annual report or too greedy to wait for a proper valuation, you are not just losing dollars. You are incinerating the hours of your life you spent earning those dollars. You are burning your freedom. The concept you are failing to grasp, the concept that separates the wealthy from the merely high-income earners who die broke, is opportunity cost. Everything you do in life is a trade-off. Every dollar you have tied up in a mediocre stock that is doing okay is a dollar that is not available to buy a wonderful business when it goes on sale. You are filling your portfolio with copper while waiting for gold, but when the gold finally rains down, you will have no bucket to catch it because your hands are full of copper pennies. This is the definition of insanity. You must view your capital through the lens of the highest and best use. If you have an investment that is yielding you a paltry return or relies on the greater fool theory to turn a profit, you are paying a massive opportunity cost every single day. You are effectively shorting the best idea you haven't found yet. In 2026, when the market's likely correct and the prices of high-quality assets compress, the opportunity cost of being illiquid will be infinite. You will see the chance of a lifetime. A Coca-Cola in 1988, a Wells Fargo in 1990, and you will be paralyzed because you are trapped in your previous mistakes. Let me explain the algebra of opportunity using the greatest hitter who ever lived, Ted Williams. He wrote a book called The Science of Hitting, which has nothing to do with finance and yet is one of the best investment books ever written. Williams divided the strike zone into 77 cells, each the size of a baseball. He knew that if he swung at a ball in his sweet spot, he would bat 400. If he swung at a ball on the lower outside corner, even if it was in the strike zone, his average would drop to 230. In baseball, you have to swing at strikes or you strike out. But here is the secret that you impatient fools ignore: investing is a no-called strike game. You can stand at the plate, bat on your shoulder for days, months, even years. The market can throw you General Motors at 40 and you can let it go. It can throw you Microsoft at 30 times earnings and you can let it go. You do not have to swing. There is no umpire calling strike one, strike two. You can wait for the fat pitch. You can wait until the market panics, until the crowd is vomiting up shares of great companies at bargain prices and the ball hangs right in your sweet spot. Then, and only then, do you swing. And when you swing with everything you have. But you are swinging at everything. You are swinging at pitches in the dirt. You are swinging at pitches over your head. You are swinging because the guy on television told you to swing, or because your brother-in-law made money swinging at a similar bad pitch last week. This hyperactivity is the enemy of wealth. It is a disease. You feel the need to be in the market at all times because you fear missing out. I am telling you that the fear of missing out is for teenagers. The fear of losing money is for adults. The ability to sit on your ass is a superpower. I have said it before and I will say it again. The big money is not in the buying and the selling, but in the waiting. It is the waiting that requires character. It is the waiting that filters out the amateurs. If you cannot wait for the fat pitch, you are destined to hit 230 for the rest of your life, grinding out a mediocre existence while the patient man waits for the 400 opportunity that changes his life in a single stroke. I speak to you not from a pedestal of perfection, but from the scar tissue of experience. I have made mistakes that would make a grown man weep, and I want to tell you about one specifically because it illustrates the pain of opportunity cost better than any textbook. The year was 1977. I was looking at a company called Belridge Oil. Now, this was not some obscure fly-by-night operation. It was a substantial enterprise sitting on massive reserves of heavy oil in Bakersfield, California. The stock was trading at around 115 per share. I looked at the reserves, I looked at the production, I looked at the price of oil. It was painfully obvious that the company was undervalued. It was not just cheap, it was a screaming bargain. The intrinsic value was clearly multiples of the trading price. It was a fat pitch right down the middle of the plate. So what did I do? Did I back the truck up? Did I sell everything else to buy this cinch? No, I bought a modest amount. I bought 300 shares for my family accounts. I was being disciplined, or so I thought. I was trying to buy it cheaper. I was haggling. I wanted a better price than the already absurdly low price that the market was offering. Then a weird thing happened. The price moved up a little. And because I was anchored to the lower price, I stopped buying. I sat there and watched it. 2 years later, in 1979, Shell Oil came in and bought Belridge Oil for $3.65 per share. Let me repeat that for the hard of hearing. I bought it 115. It was sold for $3.65. It was a 30-bagger in 2 years. The 300 shares I bought turned into $1 million, which sounds nice until you realize the magnitude of the mistake. I could have easily bought 500 shares or more. I had the capital. I had the insight. I lacked the aggression to seize the opportunity fully. That mistake, that failure to swing hard at a fat pitch, cost me roughly $5 million in 1979 dollars. But if you compound that $5 million at the rates Berkshire has achieved since then, that single error of omission has cost me billions of dollars in today's money. Billions. Because I was trying to save pennies, because I was too rigid, because I did not recognize that when you find a Lollapalooza, you must load up. That is the pain of opportunity cost. It is not the money you lose on a bad trade. It is the fortune you miss on a great one because you were distracted, timid, or cheap. Now look at your own behavior. You are likely making the inverse mistake. You are loading up on garbage, speculative tech stocks, cryptocurrencies with zero intrinsic value, overpriced real estate, and when the inevitable crash of 2026 comes, you will be underwater. You will be desperate for liquidity. And right at that moment, the next Belridge Oil will appear. The market will offer you $1 for 50 cents. And you will just stare at it, helpless, because your capital is trapped in the wreckage of your own stupidity. I am not your advisor. But if I were, I would tell you to consider clearing the decks. I would tell you that holding cash is not losing to inflation if that cash allows you to buy $1 for 50 cents 3 years from now. Cash is an option on every asset class in the world, with no expiration date and a strike price that you get to choose. When you hold cash, you are the boss. When you hold a declining asset, you are a victim. In the period leading up to 2026, the most valuable thing you can own is the capacity to act. Most of you have abdicated that capacity. You are fully invested, leveraged, and praying. You have surrendered your agency to the whims of the Federal Reserve and the madness of crowds. You are sitting ducks. The algebra is simple, but the execution is hard because it requires you to fight your own biology. You are wired to act. You are wired to follow the herd. If your neighbor buys a Tesla, you want a Tesla. If your colleague buys NVIDIA, you want NVIDIA. But to win, you must invert this. You must look at the herd and see a stampede of lemmings heading for a cliff. You must stand apart. You must be comfortable being bored. If you are over 35, you have perhaps 20 or 25 years of serious compounding left. That is maybe 3 or 4 doubling periods. If you are lucky and skilled, you cannot afford to waste one of those periods recovering from a 50% drawdown. You cannot afford to spend 5 years getting back to zero. You need to protect your downside with a fanaticism that borders on paranoia. The fat pitch is coming. The cycle always turns. The excesses of the last decade, the zero interest rate phenomenon, the SPACs, the NFTs, the sheer insanity of valuing companies at 50 times sales will be corrected. Gravity always wins. And when it does, the prices of the world's best assets will fall to levels that make no sense. That is your moment. That is the moment you have been saving for. But if you have frittered away your capital and your time on mediocre opportunities, in the meantime, you will miss it. You will be the person selling at the bottom to pay off your margin loan, handing your wealth over to someone like me who sat on his hands for 5 years waiting for you to panic. Do not be that person. Understand that doing nothing is often the smartest thing you can do. In the end, investing is not about how much you know. It is about how you behave. It is about temperament. It is about having the discipline to say no to almost everything so that you can say yes to the one thing that matters. The Bell Ridge oil mistake taught me that when the odds are heavily in your favor, you should bet heavily. But the corollary is also true. When the odds are not in your favor, which is the case for most of the market right now, you should not bet at all. You should fold. You should wait. You should watch the other players at the table lose their shirts and keep your chips in your pocket until the deck turns. 2026 will be a bonanza for the patient and a funeral for the foolish. Which one will you be? The clock is ticking, and every day you stay invested in folly as a day you are stealing from your own future. Wake up. Invert. Wait for the fat pitch. And for God's sake, stop swinging at balls in the dirt. You are drowning in information, yet you are starving for wisdom. And the reason is that you cannot distinguish between those who know and those who merely chatter. The financial world is populated almost entirely by people who possess what I call Schaffer knowledge. This concept comes from a story about Max Planck, the great physicist. After he won the Nobel Prize, he went on a tour across Germany, delivering the same lecture on quantum mechanics over and over again. His Schaffer, who drove him to every engagement, eventually said, "Professor Planck, it must be boring to give the same speech every time. I've heard it so often I've memorized it. Why don't I give the lecture in Munich and you sit in the audience wearing my cap?" Planck agreed, and the Schaffer delivered a flawless lecture. But at the end, a physicist in the back stood up and asked a devastatingly complex question. The Schaffer, without missing a beat, replied, "I am surprised to hear such an elementary question in an advanced city like Munich. I will let my Schaffer answer it." The world is full of Schaffers, people who have the vocabulary, the suit, and the confidence, but absolutely no deep understanding of the forces they are describing. Turn on your television. Look at the talking heads on CNBC or Bloomberg. Look at the influencers on YouTube who scream about the next 100x gem. These are Schaffers. They can pronounce EBITDA and quantitative easing, but they do not understand the underlying reality. They are actors reading a script written by market sentiment. They have no skin in the game. If their predictions are wrong, and they usually are, they do not lose money. They just pivot to the next segment after the commercial break. They are paid to keep your eyes glued to the screen so they can sell you incontinence pads and erectile dysfunction pills. Listening to them is not just a waste of time, it is active poisoning of your mind. You must build a mental firewall against this noise. If you are over 35 and still taking investment cues from a man who screams and hits sound effect buttons, you deserve the poverty that is coming for you. You must learn to identify the people who have Planck knowledge, the people who have done the work, who have suffered the losses, and who have a track record of survival. They are usually quiet. They are usually boring, and they almost never tell you what to buy. They tell you how to think. This brings us to the most important concept for your survival in 2026, the circle of competence. You do not need to understand everything. I've spent my life saying, oh, I don't know. To 99% of the opportunities I see, I put them in the too hard pile. I do not understand how to value a biotech company that has no revenue and a drug in phase 1 trials. So I don't buy it. It is that simple. I understand Costco. I understand that people like buying quality goods at low prices. I understand the competitive advantage of their supply chain. That is within my circle. You must define your perimeter. It does not matter how large the circle is. It matters how well you define the edges. If you step outside that circle because you are greedy or envious, the market will destroy you. Most of you are wandering around in the dark outside your circle, buying cryptocurrencies you don't understand and tech stocks whose earnings reports you have never read. You are gambling, not investing. Confucius said, real knowledge is to know the extent of one's ignorance. If you cannot explain the bear case for your investment to a 12-year-old child, you do not own an investment. You own a lottery ticket. To navigate the treacherous waters ahead, you must strip your life down to the essentials. You need a code of conduct that is rigid and unbreakable. There are 3 decisions that, if made correctly, render most other decisions irrelevant. First, you must ruthlessly lie below your means because the gap between what you earn and what you spend is your margin of safety. If you spend everything you make, you are a slave to the unexpected, and in 2026, the unexpected will be nasty. Second, you must never interrupt compounding unnecessarily, which means you do not sell your high-quality assets just to buy a boat or pay for a wedding, and you certainly do not sell them because the market dropped 20%. You sit on your hands and let the machine work. Third, and this is the one you will struggle with the most, you must remove toxic people from your life immediately because reliability is the most important trait in a partner or a friend, and if you surround yourself with unreliable, irrational, or envious people, their stupidity will eventually leak into your life and capsize your boat. These are not suggestions. These are the laws of physics for a good life. You can ignore them, but you cannot ignore the consequences of ignoring them. The modern world tells you that you can have it all. It tells you that you can be leveraged, impatient, and surrounded by fools and still win. This is a lie sold to you by people who want your money. The truth is that getting rich is simple, but it is not easy. It requires a level of discipline that most people find repulsive. It requires you to say no when everyone else is saying yes. It requires you to look like an idiot when the herd is partying so that you can look like a genius when the herd is panicking. In 2026, when the liquidity dries up and the margin calls go out, the people who stayed within their circle of competence, who ignored the chaw fears, and who adhered to the 3 decisions will be the ones picking through the rubble, buying dollar bills for 50 cents. The rest of you will be the ones selling the dollar bills. The choice is yours, but the time to make it is running out. You cannot build a shelter when the hurricane is already overhead. You must build it now, while the sun is still shining, however weakly.